Hey guys, my name is Evan and welcome to Evanomics 101, your number one source for everything econ. Have you seen the headline saying the U.S. economy is slowing, only to hear someone else say the economy is actually doing just fine? Well, that's exactly what's happening with the newest GDP report. The latest number shows the U.S. economy grew at an annualized rate of 1.5%, which is slower than many economists expected but below the previous quarter's pace. But once you dig beneath the headline, the story becomes much more interesting. Today we're going to break down, in plain English, what the GDP report covered. We're going to break down why GDP slowed to 1.5% and what caused the slowdown, which parts of the economy are actually showing strength, and we're going to cover what this report could mean for the Federal Reserve, financial markets, and your wallet. But before we jump into the video, I do have a quick favor that really helps grow the channel. If you find simple breakdowns like this helpful, please share and subscribe. Now let's dive into the numbers. So let's start with the headline. The U.S. economy grew at an annualized rate of 1.5% during the second quarter of 2026. Now at first glance, that sounds like bad news. Anything under 2% is going to sound like bad news. After all, slower growth usually makes investors nervous because it can mean businesses are expanding more slowly, hiring could cool off, and consumers might be pulling back on their spending. But GDP isn't simply a scorecard that tells us whether the economy is good or bad. Think of GDP like an annual physical at your doctor. Your overall health isn't determined by one number. Your doctor looks at your heart rate, your blood pressure, your cholesterol. The economy works similar. GDP combines millions of economic transactions into one measurement. Sometimes that number falls because people stop spending. Other times it might fall because accounting effects like imports or inventory changes, even when consumers and businesses are still relatively healthy. That's exactly why economists always look beneath the headline before drawing conclusions. And when they did this time, the picture becomes a lot more complicated. So if consumers were still spending, why did GDP slow? Well, there are several major reasons. One of the biggest pullbacks came from imports. And I know that sounds a little bit backwards, but I'm going to explain it. So why would buying more products hurt GDP? It's because GDP measures what is produced inside the United States. If Americans buy more imported computers, machinery, or electronics, that spending counts as imports, which are subtracted from GDP calculations. This quarter saw a notable jump in imports, partially tied to continued business investments in AI-related equipment and technology. Government spending also softened compared with previous periods, adding another modest, somewhat drag on overall growth. So when you combine imports, inventories, and softer government spending, it's easier to understand why the headline number slowed down. But naturally, that raises the next question. If these factors pulled GDP down, what was keeping the economy moving forward in the first place? So the biggest positive surprise was the American consumer. The American consumer has been resilient through all of this. So consumer spending accelerated to roughly 3.2% annualized, a sharp improvement from the previous quarter, and one of the strongest supports for overall economic activity. Since consumer spending makes up roughly 2/3 of U.S. GDP, that's a significant sign of resilience. Businesses also continued investing, partially in technology and AI infrastructure. So here's the takeaway so far. The economy is not booming by any means. No, it's not. But it isn't falling apart either. Instead, we're seeing an economy where headline growth looks weaker than the underlying fundamentals suggest. And that leads to the biggest question investors are asking right now. What does all of this mean for inflation, the Federal Reserve, and the stock market? So now that we've looked at what drove the GDP report, the next logical question is, what does this mean for the Fed? Okay. Remember, the Federal Reserve has a balancing act that it has to do. It has two main goals, or its two biggest goals. Number one is keeping inflation under control. Number two is supporting maximum employment. If the economy is growing too quickly, inflation can start to accelerate again. But if growth slows too much, businesses may hire less. Unemployment could rise and the economy could slip toward a recession. That's why reports like GDP matter so much. So this puts the Federal Reserve in a tight spot. If inflation continues to move toward its target, while growth remains modest, policymakers could have more room to lower interest rates later on this year. On the other hand, if consumers continue spending money aggressively, and inflation proves stubborn, the Fed may decide to leave rates higher for longer. That's why investors don't look at GDP as just one number or look at GDP in isolation. They'll also be watching upcoming reports like CPI. I just did a video on the current CPI numbers. I'm gonna have a video coming on employment number. They're also gonna look at retail sales, consumer confidence. Think of GDP as one chapter in an economic story, not the entire book. And that's exactly why Wall Street rarely to just one number. Quick pause, guys. If you want more breakdowns like this that simplify economics, inflation, Federal Reserve decisions, please hit the like button. This was somebody who was into this kind of content. Now let's see how they interpreted this report. So whenever a GDP report comes out, investors immediately ask one question. Is it good news? Is it bad news? The answer is it depends. For the stock market, slower GDP growth isn't automatically negative. If growth slows because inflation is easing and the economy remains healthy, investors may actually welcome the report because it could increase the chances of future interest rate cuts. Lower interest rates generally make borrowing cheaper for businesses and consumers, but if GDP continues slowing over multiple quarters and businesses begin cutting jobs, then investor sentiment could change quickly. So for everyday Americans, this report also has real-life implications. If economic growth slows gradually while inflation continues to cool, consumers could eventually benefit. But if inflation stays elevated despite slower growth, families could face a tougher combination of slower wage gains and persistently high prices. That's why you have economists often describe today's economy as being a transition period. The next few months are going to be critical. We'll learn whether this GDP slowdown was simply a temporary soft patch or the beginning of a broader slowdown. So, what's the biggest takeaway from today's video? The headline number, it grabbed everybody's attention. At 1.5% growth certainly looks slower than many people hope for. But once you dig beneath the surface, you discover an economy that's much more resilient than the headline suggests. Consumer spending still remains strong. Businesses continued investing. Some of the biggest drags on GDP came from factors like imports and inventory changes rather than sudden collapse in demand. That's why it's important to look beyond the headlines. Economic reports are rarely as simple as just one number. So now I want to hear from you. Do you think the U.S. economy is headed for a softer landing, or do you think we're still facing a bigger slowdown ahead? In my opinion, we are facing a slowdown ahead, but right now the American consumer remains resilient. This Economics 101, your number one source for everything econ. I look forward to seeing you on the next video.